Adoptive notes to the consolidated financial statements. Note number 5. Significant accounting judgments, estimates, and assumptions on the preparation of the company and its subsidiaries' consolidated financial statements requires management to make judgments and estimates and assumptions that affect the reported amounts of revenue, expenses, assets, liabilities, and the accompanying disclosure of contingent liabilities at the reporting date. However, uncertainty about these assumptions and estimates could result in outcomes that require material adjustment to the carrying amount of the assets or liability affected in the future periods. Other disclosures relating to the companies and its subsidiaries' exposure to risks and uncertainties that presented in Note 34 include capital management, financial instruments, risk management and policies, sensitivities, analysis, disclosure, judgments. In the process of applying the company and its subsidiaries' accounting policies, management has made the following judgments, which have the most significant effort on the amount recognized in the consolidated financial statements. Revenue recognition and measurement of progress. The company and its subsidiaries recognize revenue when it satisfies an identified performance obligation by transferring a promised good or service to a customer. A good or service is considered to be transferred when the customer obtains control. The company and its subsidiaries determine at contract inception whether it will transfer control of a promised good or service over time. If the company and its subsidiary do not satisfy a performance obligation over time, the performance obligation is satisfied at a point in time. In determining the revenue recognition for the sale of residential properties, the company and its subsidiaries determine whether the company and its subsidiaries' performance does not create an asset with an alternative use to the company and its subsidiaries, and the company and its subsidiaries have an enforceable right to payment for performance completed to the date. The properties have no alternative use for the company and its subsidiaries due to contractual restrictions. However, the company and its subsidiaries have no enforceable right to payment for performance completed to date, as there is no legal resources or legal basis requiring the customer who has breached or defaulted under the contract to compensate the company and its subsidiary with an amount representing the company and its subsidiaries' incurred cost plus a reasonable profit margin. Therefore, revenue is recognized at a point in time when the completed residential property is handed over. For construction services, the company and its subsidiary concluded that the revenue is to be recognized over time because the company and its subsidiaries' performance create or enhances an asset, such as work in progress, that the customer control as the asset is created or enhanced. The company and subsidiaries determine that the input method is best method in measuring progress of the construction services because there is a direct relationship between the company and its subsidiaries' effort and the transfer of service to the customer. The company and its subsidiaries recognize revenue on the basis of the actual cost incurred relative to the total estimated cost to complete the service. Okay, judgments continued. Revenue recognition and measurement of progress. For the sales of management services, the company and its subsidiaries concluded that revenue is to be recognized over time because the customers simultaneously receives and consume the benefits provided by the company and its subsidiaries. The fact that another entity would not need to reperform the services that the company and its subsidiary have provided to date demonstrates that the customer simultaneously receives and consumes the benefits of the company and its subsidiaries' performance. As it performs, the company and its subsidiaries determine that output method used in measuring the progress of the performance obligation faithfully depicts the company and its subsidiaries' performance in transferring control of the services to the customers. Consideration payable to customers. The company and its subsidiaries recognize consideration payable to customers when cash amounts are paid or expected to be paid by the company and its subsidiaries to the customers or to other parties that purchase the company and its subsidiaries goods or service from the customers. An amount that is considered as consideration payable to customer shall be accounted as a reduction of transaction price and therefore of revenue unless the payment to customers is in exchange for distinct good or service that the customer transfer to the company and its subsidiaries. The company and its subsidiaries determine that incentives provided to the customers through incentives provided to the customer through interest support are consideration payable to customers. Interest support to be paid to the bank in favor of customers presents an incentive paid by the company and its subsidiaries to encourage customers to purchase residential property. This incentive is accounted for in reduction of transaction price based on the present value of interest support payable. Performance obligation. The company and its subsidiary identify performance obligations by considering whether the promised goods or service in the contract are distinct goods or services. A good or service is distinct when the customer the customer can benefit from the good or service either on its own or together with other resources that are readily available to the customer, and the company and its subsidiaries promise to transfer the good or service to the customer is separately identifiable from other promises in the contract. The company and its subsidiary integrate the land area, various land developments, and house and other significant activities, water distribution, electricity, drainage, sewerage system as promised in its contract with customer. These promises, this promised are combined into one distinct performance obligation, which is the sales of residential property. The company and its subsidiaries also consider the provision of management services as a separate performance obligation from the sales of residential property. The customer can benefit from the property and the management service on their own, which are separately identifiable since they are not integrated into the combined output, do not significantly modify or customize each other, and are not highly interrelated. Warranties. The company and its subsidiaries generally provide warranties for general repairs of defects that existed at the time of sale as required by law. As such, the warranties as assurance type warranties which the company and its subsidiary account for under IAS 37 provision contingent liabilities and contingent assets. Next, judgments continued. Significant financing component. The company and its subsidiaries assessed whether a financing component from its contracts with customers is significant by considering all relevant factors and circumstances such as difference, if any, between the amount of promised consideration and the cash selling price of the promised goods or services. The combined effort, the combined effect of both expected length of time between when the entity transfer the promised goods or service to the customer, and when the customer pays for those goods or service, and the prevailing interest rate in the relevant market. The company and its subsidiaries determine the financing component for each payment scheme. Spot cash transactions constitute a significant financing component due to the difference between the timing of the payment and the transfer of control over the purchased unit. In the case of installment payment, initial down payment amounting to 30% of the selling price of the property are assessed to have no significant financing component, as these are used to protect the company and its subsidiary from the customer's failure to perform its obligation under the contract. The company and its subsidiaries determine the financing component for the remaining installment payments received from the customer for the sales of residential properties at the contract level. With the reference to the calculated interest, the remaining installment payments for contracts within 2 or 3 years prior to the handover of the purchased units may or may not have a significant financing component and will be assessed on a per contract basis. As a consequence, the company and its subsidiaries shall adjust the promised amount of consideration for the effects of the time value of money in determining the transaction price of its contracts with customers. In determining the interest to be applied to the amount of consideration, the company and its subsidiaries concluded that the borrowing rate of the company at the similar period for 2 or 3 years is appropriate because it is commensurate with the rate that would be reflected in a separate financing transaction between the company and its subsidiary and its customer at contract inception. Okay, next, assessment of control. The company assessed that it controls another entity investee, regardless of the nature of its involvement with an entity when it is exposed or has rights to variable returns from its involvement with the investee and has the ability to affect those returns through its power over the investee, normally represented by ownership of voting rights. The company assesses its control over an investee despite having more or less than a majority of voting rights based on potential voting rights or other contractual agreements. In 2018, the company transferred 37.78% equity interest in Fatlock Commercial Investment Trading Limited liability company to a corporate counterpart, Note 7. After the transaction, the company still owns 51% equity interest in this company. According to capital transfer if agreement, the company transfer all voting rights associated with the remaining equity interest to the buyer after the company received the first payment for transferring 37.78%. Therefore, the company that um, assessed that it no longer has control over Fatlock Limited Liability Company at the reporting date and does not consolidate it as a subsidiary. For acquisition of subsidiaries, the company assesses that it controls an acquired subsidiary since the dates when the company and its subsidiaries were named on the shareholder register of the subsidiary. As from that date, the company and its subsidiary can be fully exposed or has rights to variable return from its involvement with the investee and has ability to affect those returns to its power over the investee. Next, business combination. The company acquires subsidiaries at the time of acquisition. The company consider whether the acquisition represents the acquisition of the business or the acquisition of group of assets and liabilities. The company accounts for an acquisition as a business combination where an integrated set of the activities and significant processes are acquired in addition to the property. When the acquisition of subsidiaries does not represent a business, it is accounted for as an acquisition of group of assets and liabilities. The cost of the acquisition is allocated to the assets and liabilities acquired based upon their relative fair value, and no goodwill or deferred tax is recognized. In the business combination in which the acquirer and the acquiree exchange only equity interest, the acquisition date fair value of the acquiree's equity interest may be more reliably measurable than the acquisition date fair value of the acquirer's equity interest. If so, the acquirer shall determine the amount of goodwill by using the acquisition date fair value of the acquiree's equity interest instead of the acquisition date fair value of the equity interest transfer. In 2018, the company acquired Vinhomes Trading and Real Estate Management by issuing 381 billion shares in exchange for 381.5 billion million shares of this entity. The company assessed that the fair value of the acquiree's share is a more reliable measurement of fair value of consideration. Okay. Recognition of deferred tax in business combination. Certain business combination made by the company and its subsidiaries may provide the opportunity to revise the tax base of an asset to an amount equal to the fair value assigned to it in the accounting for the business combination. In such case, the company does not recognize any deferred tax liabilities where it anticipates a subsequent increase to the tax base resulting from the implementation of restructuring plan that has been approved as um, of the date of acquisition. In 2016, the company and its subsidiary acquired 80.94% shares of Ecology, just a company from certain individuals. The company and its subsidiary does not recognize the deferred tax liability for the fair value adjustment of the residential property, as the company and its subsidiary have already obtained the approval as of the acquisition date to implement organizational changes that will result in an increase in the tax base of the said residential property. In 2018, the company and its subsidiaries estimate no further tax benefit can be recovered from the initial planned organizational changes. The company and its subsidiaries access that it is changed in accounting estimate and recognize deferred tax liability corresponding to the remaining temporary difference as at the reporting date. Classification of property. The company and its subsidiaries determine whether a property is classified as investment property, property and equipment, or inventory property. Investment property comprise land and building, principally offices and retail property, which are not occupied substantially for use by or in the operation of the company and its subsidiary, nor for sales in the ordinary course of business, but are held primarily to earn rental income and capital appreciation. This building as substantially rented to the tenants and not intended to be sold in ordinary course of business. Property and equipment comprise property which are occupied substantially for use by or in the operation of the company and its subsidiary. Investment property comprise property that is held for sale in the ordinary course of business. Principally, this is the residential property and commercial property that the company and its subsidiaries develops and intends to sell before or on completion of construction.